On March 18th, the Bank of Japan brought Japan out of an 8-year-long experiment with negative rates. The yen sold off while the Nikkei 225 rallied. Now, typically, the reaction to a rate hike would be the opposite. Usually the currency would strengthen, and more often than not, the equity market would sell off. But there's something special and different about negative interest rates. Rather than stimulating growth, they instead act as a tax on the banking system. The idea of negative deposit rates is to discourage excess savings and therefore to spur spending and investment. But markets seem to think that they have the exact opposite effect. Now, if you look back to January 29, 2016, the day that the Bank of Japan first put rates below zero, the yen strengthened versus the US dollar, the opposite of what usually happens after a rate cut. Moreover, the yen continued to rise versus USD during the months afterwards, with a total gain of about 10%. The Nikkei 225 slumped in late January and in February 2016, when the Bank of Japan initially set rates negative, and then rallied when they ended negative rates. Overall, the Bank of Japan's first step towards higher rates might have the paradoxical effect of further stimulating economic growth by repealing what amounted to a tax on the banking system. Now, eventually, higher rates could have the impact of slowing growth, as they do elsewhere, but that would be likely to require rates much higher than the current 0 to 10 basis point range.